Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome Charles Carillo. Hi, Charles.
Hi, Mike. Thank you so much for having me on the show.
Thank you for coming on the podcast. I appreciate the opportunity to be on your show, and let me introduce you. So you're a managing partner of Harborside Partners, a real estate syndication firm. You have been actively investing in multifamily and commercial real estate since 2006, investing over $200 million. And you run a podcast called Global Investors Podcast, where you interview industry leaders talking about U.S. real estate. So welcome once again.
Thank you so much.
Before we dive into business, a little bit about you. Where do you live? Family, kids, cats, pets, whatever works for you.
So I'm originally from Connecticut. I moved down to Florida, where I am now in South Florida in Palm Beach County area in 2012. And I grew up in the real estate business. So as you mentioned, I've been a multifamily investor since 2006. But my father kind of gave me got me into it, I guess you would say. He bought his first multifamily property a few months after I was born. And it was a 6-family property. And he, that was kind of my second education of him building up this portfolio. And they were pretty tough properties, right? Like a lot of D properties, C- properties. And I wasn't really interested in any of this. So I was like, no, this is nothing I'd want to do. And as he transitioned, I guess, into better properties, kind of as he understood, which is the normal, route of most investors that are active, where they start with lower class properties, let's just say, and they're getting into more ideal properties, newer properties, less management intensive properties. And when I started investing, my first property was a 3-family property, and from a small city in Connecticut, and I house hacked that one back then before they really called it house hacking, and really just bought, realized that real estate super, super local, and buying properties even a couple blocks from each other completely could be a very different outcome investing. So it takes investor really has to know the market and the neighborhood. And that was one thing that as my dad was buying better properties, it was something that, I started buying better properties too. And, since really 2022, we sold out all of our C-class properties. I sold out a portfolio I had in Connecticut as well, and really just focusing on B-class and above properties. You're getting better tenants, and it's less management intensive. So that's kind of what I've been doing, and really my whole kind of career in real estate.
Yeah, I got you. I appreciate that. We're just in Connecticut. Connecticut, one of my daughters figure skates, and they train in Stamford, Connecticut, Chelsea Piers. So,
Nice.
In any case, you're absolutely right. All real estate is local. I live in New York City, and you can go 2 blocks or 1 block in one direction, things change. So sometimes these neighborhoods transition from one to another super fast. So I absolutely agree, especially in big cities. So now let's shift to the investing. And I think you mentioned in the past, at least through other conversations, you invest sort of in Florida, Dallas-Fort Worth area, Atlanta. Let's talk a little bit about those markets. How are your investments doing today, given the fact that we've seen market correction, higher for longer interest rates, insurance premiums skyrocketing, a number of other factors that have been challenging for multifamily operators. So let's just talk about that, and then we'll shift to the opportunities ahead.
Yeah, I think each of those markets has had distinctive issues, I guess, or setbacks. And I was talking to an investor yesterday, and even with all the new product and inventory that's come in the market in a lot of these markets, a lot of these markets are very resilient. I know like Austin, some other markets have really getting hit with nearly 10% decreases in rents. But in a lot of I would say your really core markets, like Dallas is a very core market. You have 50 Fortune 500 companies there. It's even with the supply they put in there, it's still, we still keep our occupancies in mid 90s there without a problem, as doing a value add strategy. So we had property taxes in Texas have been killer over the last couple of years. Obviously, interest rates is everywhere, and then with Atlanta, the big thing we've had that's really plagued a lot of people in inside of Atlanta. We're one of our properties that we have there is kind of on the suburbs, but it's been that a lot of skips, and then we've also had issues with evictions there. And that's what people have had. We've been lucky there. We have a property there that I just checked numbers is 96.2% rented there, occupied. So we're doing well there. Our collections are very high, but a lot of people have had issues with Atlanta. And then Florida, obviously, it's the insurance. I mean, that's just one of the things that's really come back to hurt down here in Florida as one of the things because you have these insurance premiums and a lot of things that kind of lag. We see inflation go up, but we don't really see it. And then we see it like the tailwind of it, right? Coming back months later, year later, as you start seeing these premiums redone. I mean, and it's not just I saw double-digit returns, double-digit increases in insurance in Connecticut, you know what I mean, before I sold portfolios there. So that was already, those were renewing the beginning of 2022, and you already start seeing like the hits of this coming through. And then it really just went 2022 end of it, 2023. And so it's one thing for people that are on the sidelines now going back in, hopefully, you're going to see a lot of those increases have already happened. And for people owning the properties, holding properties, I mean, it's tough now because you're not really able to raise rents to really recoup that and then put interest rates on top of that. If depending on how you capitalize the property, I mean, you could be in a very tight spot.
Yeah, I appreciate that. And I really appreciate clarification depending on the market. So Florida, they get hurricanes, so it's a hurricane of insurance increases, right? So essentially, insurance skyrocketed. And you said Central Florida, which is different from the coastal. Coastal is even worse. And there was a tidal wave that hit the entire country. I mean, we saw increases here in New York, 30% year over year. This was insane. You think about this. I guess insurance companies took massive losses, but certain markets worse than others. And then, interestingly enough, new supply, right? That whole problem was from the time when interest rates were low. New construction starts were easy, and the volume, the starts was huge. And now they're being delivered, and they're creating inventory glut or creating competition. But what's really interesting, 2 years from now in 26, we're expecting that there will be very limited new deliveries or much reduced new deliveries. So as a result, if you can persevere all the way to that point of view, of course, you will have better pricing power for rent increases, right?
Yeah.
And
sure.
Atlanta, yeah, I've heard that from many people. That whole statement, if you're in the wrong part of Atlanta, you're dealing with the Socialist Republic of Atlanta, right?
Yeah.
Where I live in New York. It's the same thing here. You go evict somebody, good luck. It's the worst process in the whole country. You could be evicting somebody for 1.5 years, even 2 years, if they put up a good fight. Right, it's kind of insane. They can live in an apartment without paying your rent, and just come in front of a judge with a crying baby, or saying I'm disabled and I don't have the money, and the judge is not going to kick you out, not going to kick them out. So from that perspective, as a landlord, of course you are sympathetic to their situation, but at the same time, you have to pay your mortgage. You have to pay insurance, right?
Yeah. People don't understand, I think, when they see them paying this large chunk of their income to this greedy landlord, and then they find out if you actually work down the numbers for most landlords, we're talking like less than a 10% profit margin. You know what I mean? So it's like, this is not a high margin business per se when you have everything put together with financing and everything that goes with it. Now you have some landlords that have paid off properties or have, bought many years back and they have a big spread, but like, that's how it all works. That's how real estate works, where you're supposed to buy it and hold for long periods of time. And when you do that, you start having that spread, increase. But the one thing with financing too, is that even makes it more difficult is if you're in one of these areas where evictions are difficult. And if you have some sort of government insured mortgage, and Fannie and Freddie just came out with new requirements for this as well, where you now have to really follow what they're doing. And the first taste of this I really got was like in COVID 2021 in Connecticut, with some properties had there. And the only way I was able to, because I had bank loans from local banks, and that was the only way. That's what it came down to, as my attorney was telling me afterwards. They said, provide all this documentation showing it's not government insured. And that was the only way I was able to get tenants out of, that hadn't paid in like 10 or 12 months. You know what I mean? That even had canceled their electricity. So they weren't even living there. I was paying electricity as well. So it's like, this is how, when you start, you have to really, it's not just the area where you're in now. Now it's also the type of financing you're getting, which something really wasn't a problem prior to COVID. You know what I mean? This is something where they started kind of flexing. You're using money from us. Now you have to follow our rules. And this is something when I tell investors, it's like, they're not always, look at all your different financing issues, because now you have someone else that you have to bring in as a partner, really. You know what I mean? That's making decisions, and it's never in your favor. It's like, it's like bringing the IRS in. You know what I mean? They're always that silent partner, and it's, they're always there, and it's something you have to understand. So maybe it's better getting, instead of this this type of financing where they always say, well, it's my personal assets aren't at risk. Well, true, maybe, but it's also one of the things too is that if you're buying a property and you're not going to do any more deals with the agency anyway if your property goes down. So you know what I mean? So you're going to be blacklisted there anyway. So if you sign on it, now you have full control, and the bank's not going to be bothering you. They just want to make sure they're paid mortgage. They're not going to be there sending out inspectors there like the government sponsored entities do. So it's one more thing, just to go on a little tangent there about financing in general.
Yeah, I appreciate the clarification. Kind of interesting. You can get in bed with the devil in essence if you're getting government dollars, and you have to follow their requirements. But let's kind of move forward now. So all these things we just described, the sort of challenges for multifamily operators, owners, syndicators, from the checks written in the past. And especially 21, 22, those investments were bought at the peak of the market, and valuations have corrected. So just how much valuation corrections have you seen? Again, I don't know if it's anecdotal or systematic, but these so-called Sun Belt regions, we're talking about Florida, obviously Texas, Atlanta. I've heard different numbers. Some folks have talked about 20 to 30% range, which is about right. But I'm just curious your point of view. And then switching, well, that's what happened in the past. Is that the time to go in now from the point of view, if you can get into some of these situations where the owner is struggling, you can buy it at the right price, then the forward outlook is very different. So let's just talk about first, what's been your experience on the existing assets and valuation corrections?
I think what we've seen is been a little less of a decrease than 20 to 30%. I would say it was more around 15%. It hasn't, cap rates haven't really expanded that much that you would think with what's happened with interest rates over the last 24, 30 months. And I think that's an interesting point there, because you would always think that, this was going to go away. This is going to be going down. We're going to have all these deals. It's the thing we've been hearing for years and years, all these deals available, everything coming on. And maybe you're seeing those big price swings or decreases on lower quality properties, let's say, you know what I mean? Properties that might be 50, 60 years old. Yes, I could probably see that. But on the, more ideal properties, your B class, B plus properties, built after 1985, after 1995 type properties, these don't have that big a swing that we've seen. You know what I mean? And it's, I think right now it's just one of those points, like with one of our properties, we had a rate cap that expired earlier this year. We bought in 2022, no problems with that property. We put another rate cap on for 6 months. And so we have like another month or two on that. But now it's one of those things where, do we refinance? Do we shave off like 2% or 2.5% on our interest rate? But now we have that big prepayment penalty. Or is it something in the sense of, do we just kind of hold on to what we have now with bridge and just like see as we, take those decreases as they come, you know what I mean? So
let's talk on the topic a little more. That's a very relevant problem today. That's as fundamental as it gets. So if you have existing loan and you have an expiring rate cap, I've seen two scenarios. The bank's requiring either a new rate cap if you're maintaining the same bridge, or you have to set aside some kind of interest reserves to cover the gap, essentially equivalent of a rate cap, except for you, it may work better as interest rates fall and you're on a floating rate mortgage. You're not basically prepaying at a high interest rate. So I've seen those two scenarios. But your trade-off is exactly what you mentioned: refi at the current high interest rates, and then lock in prepayment penalties, yield curve maintenance, and we know the rate's going to fall. So it's one of these things where it's a tough choice, whether you hold the bridge for longer and just wait it out until better times, or you bite the bullet, buy the security, but then you're locked in for multiple years. So
True.
again, what are your thoughts? What are you thinking to do?
I know I'm having a call with an investor in 3 hours, and this is the same conversation I'm going to have with him. And it's one of those things because if like, as we're saying, we know inventory is slowing down next year, right? We had record deliveries. We know it's going to slow down next year, and even 2026, it's going to slow down even more. So as you're having these deliveries slow down, it's not just deliveries coming on, is you have these concessions that come along with it. So you really need, after they come online, you've got to wait out like a year for them to really, for those loss to lease to little burn off. You know what I mean? And that's where you're back to really a level playing field with my 1988 built property and your property built in 2023. And so where now there's this discrepancy of $600 or $700 a month in rent, and that's where we're able to rent without an issue compared to, well, you're giving away 2 months and all this kind of stuff that goes with it. And now it's becomes more difficult for luring new people in, and they're not like checking your income and all this kind of stuff to get it all filled up so that they can get some permanent financing on the property. And the thing though is that what we found going forward now with what you have is that the problem is that it's twofold, because if like you said, interest rates, that's what we're saying, going down. And then if you have yield maintenance on that, not only am I paying a prepayment penalty, but the more that rate goes down, now there's more that I have to pick up when I'm paying off in the prepayment penalty because I agreed to a certain yield, you know what I mean, to that lender. So now it's something that it gets even more expensive as that rate goes down. It's different if you're selling, rates go up, and I'm selling something with a prepayment penalty. The prepayment penalty is usually not as bad in certain situations because they can now put that money back out in the street into other properties, and they're getting a higher interest rate. But now we have this issue. So you're like, do I go down, do we cut off 2.5% and go to like 5, whatever it is, 5.5 we get on a mortgage now, maybe 5. And then the problem is that have this massive 7-figure prepayment penalty when we sell the property. And who knows, at this situation, you might do that and paid these before. And it's like, there might be a slowdown. You might have a lot of this new inventory might be slowing coming on the market, whatever it is, new starts, and you find a buyer next year. And now you had 1 year, whereas you could have just rode that out. And so it really depends on what your team does and exactly like if they're really interested in selling it, you know what I mean? Or what it is. I mean, I've seen, stuff that comes on the market now. We had a lot of distressed stuff that's come on and it's still going through the paces. But I think as we get into 2025, that's going to start slowing down because you're going to have a lot of people that already did workouts with their lenders. Because most people, when they got these bridge debt, they had 2-year caps on their interest rates. Right. So these are burning up as we speak. You know what I mean? Over this next 4 months. So I think 2025 is going to be a little different story with these properties coming on. And then I also think banks are more likely with better properties to keep them, to work them out compared to if you have a property that's a lot of deferred maintenance wasn't able to be done, they might let that one go. And that's what a lot of buyers in the syndication space don't really focus on. So I don't know how those are going to be picked up on that end. It's definitely for us, it's probably not going to be something that we're looking at. But so it's really that balancing act between what do you do and how long are you going to keep it? If you're keeping the property for 2-3 years and that's what your goal is, at least, maybe you go with the fixed debt and then work it out knowing that what we're saving every month, we're going to be paying back a little bit in the prepayment penalty or, a portion of that, maybe sizable portion.
Yeah, I appreciate that. That's a great analysis. And I can tell you this, that on the deals we've been involved, optionality is worth paying extra costs. So optionality meaning that just extend the bridge, even though it's painful. But the question is, where do you raise the capital to extend the bridge? So we've done some of the mezz debt on some of these deals where we come in with this, let's call it recovery capital, and gives them time, especially if the property call it enough equity rich, cash poor. Yeah. So optionality could be very, very valuable because the drop in the interest rates could be significantly more valuable than being stuck for 5 years at a higher interest rate. From that perspective, it's a significant. It's almost like this: it's clear rates they're going down, and just the speed of how fast they're going to go down. But one way or the other, a year from now, cost of financing could be 100 basis points lower, just plus minus, right? We don't know that. It could be 75. But that's a very significant savings, in essence, on the interest costs and having the optionality to sell versus sort of holding on to the property for 5 years. So basically, everything you discussed makes a lot of sense, and it's individual depending on the circumstances. But let's now move forward. New opportunities. Are you seeing interesting deals now? Is what kind of deals? And granted that you're no longer looking for tough properties, you're looking for the better, easier assets. And I think majority of the people have gone through, let's call them C minus properties. At some point, you just kind of conclude, do I want to battle that? It's so tough. You're dealing with very, very difficult execution. And one of the other points that most people don't realize, they perform these deals wonderfully, but they can't get to the target NOI because you can't get to the collections. You can't get through the rent increases. You can't get through the math. So you wind up with lower NOI, and then even the cap rates didn't necessarily expand as badly as we thought, but the NOI is just not supporting the valuation. So it's at a perfect execution. You could do perfectly. It's called NOI math and a cap rate. So what I'm pointing out to execution is harder than it looks, and we've seen this again and again where people just project. I don't call it perfection, but pretty good execution. And if you get hit with any difficult events, insurance spikes, or a hurricane comes through, or collection issues, or during the inflation day, cost of construction went up. A lot of these projects struggle. Now the reverse. Now we find ourselves September 24. You are looking to deploy new capital. How are you looking at things? What kind of opportunities you're seeing? What kind of projects? What markets? Just curious. What are you seeing today, and what do you expect? Let's call it in the next 6 months.
So like what we're seeing now for deals coming through is it says deals that are on the market, and then also looking at I'm on a lot of different email lists for people, syndicators raising money. And what I've seen on a lot of deals coming through from syndicators that are raising capital for the deals, what I've seen is really simple business plans that are really don't have much value add. They're very light value add, or they're really just taking away the loss to lease. And they're not like true value add plays. And obviously this is a much safer investment, but a lot of people are going for that. So they don't have to put out as much capital. They don't have to have their vacancy drop as much. I mean, it's all safer all around. You know what I mean?
But are they getting the right price? That's the big issue. Because these safer looking deals with high occupancy, they're not getting big enough discount. They make it look like a safer deal, but in reality, you're not getting a lot of value add. You're already substantially fully occupied. You're thinking it's a lower risk deal, but is it? It's only lower risk deal if you're getting the right price. If you're not getting the right price, then what are you getting?
Yeah, I think you have some of these value add operators that kind of got really caught in 2022, 2023, and I think they're going to simpler problem, but it's really, I think the mistake that's being made with a lot of this is they are yield kind of plays that they're trying to make into value add plays. So these are not deals. These are long-term, if you bought the property and held it for 10 years and you'd be fine, you know what I mean? And you're cleaning up a little bit of things here and there, but to get the returns, I just don't see it. And that's what I mean, because for any kind of deal really to be able to raise money and to really pencil out for most investors and syndicators, it really needs to be a 15% IRR plus, you know what I mean? So I just don't see how you're able to achieve that without doing much work. So a lot of deals that we've seen that's come across our desk, on market or from brokers, there's not that much of a discount to make it worthwhile. And kind of the deals that we've
discounted a couple of years ago. Because what you did describe today, what this second you just described, as they're marketing these deals, sort of the brokers at a value that's not a steep discount to the past valuations, and the forward money. If you can't come up with 15% IRR on equity today, this is a garbage. This is no deal. We're looking at deals. If you want to write an equity check, I want to see a deal with 25% IRR. Okay, we can look at let's call it 20 to 25% on equity, okay, you could justify the case depending on various variables and risk factors. 15, what the hell is 15? I mean, I'm sorry, I mean this, it's like, okay, 15, I can make 15 lending money in a first lien position, 14% hard money loans. We're still doing them today. So 15% return on equity doesn't, like, you're not getting a deal. I don't know what you're getting.
Right.
So it has to be better deals. And that's the question. In theory, if you're getting historically depressed pricing or historically discounted pricing, these deals better be good. I mean, they better be much better target IRR with conservative assumptions. Otherwise, you're not. It's something that you don't want to transact. It's kind of like you didn't find anything interesting, and I don't know how you can raise money for it. I don't know how you can do anything. It's more like, okay, that's somebody it's a seller holding their price, and it's good for them. It's not good for you today. Today, if it's not a really good deal with 20, 25% IRR, then why it's not even worth the time. Even if it looks like a core plus deal, it needs to have those numbers. As crazy as it sounds, people are saying, well, core plus, low value at 15% plus. Not today, not if you're buying today, because the market conditions are such, the rates are high. So you better be getting a good deal. Otherwise, something is off, right?
Yeah, I totally see that. I'm just seeing that, usually for this whole process to work is you really have to have a path of how you're going to raise rents on a property 20 to 25%. I mean, that's really what it comes down to. And when you start seeing people that are saying, well, we're going to, there's 10% or 12, it's not going to pan because you're not going to get returns out to investors. So they're buying properties that are really, yield plays. They're just properties that are buying that are single digit return type properties, and by them trying to raise rents or whatever, trying to get rid of lost lease, you're going to try to reach this return, with a high, teen kind of return, whatever it is. And I just don't see the way of doing that. It's completely risky. It's a different thing if you're going in and you start seeing this differentiating factor of 25 or 30% versus other properties that are there in the market and like nearby in their neighborhood. That's a whole different conversation, but I just don't see that. So I just haven't seen the discounts, and kind of what we've been doing in-house is we've been focusing on doing small JV deals with just a couple of our partners on properties that we're finding, and that where you're able to kind of work out some creative financing with investors and work with local banks. So that's really the route we've been doing. We haven't done really that many syndication deals. The last syndication deal we closed was at the end of 2022. So it's something that we have a very small firm, and I think that's one of the other things too is when you see deals like this and when you look back at the firm, sometimes is always in my mind is that if this is like a acquisition fee type, to keep the firm kind of going type of thing. There's too many people and stuff like this. So that's always a worry I would have when I see deals like this. You know what I mean? Because a lot of the smaller operators that I've worked with, that I have some past investment deals with, I'm not getting any deals from. You know what I mean? And when I speak to them on the phone, they're like, "Oh, we haven't we underwrote this deal and this deal, but like we're not doing anywhere near as what we used to do because it still hasn't like come to our level, like you were saying, Mike."
Yeah, Charles, transaction volume is still incredibly low. That's one thing that's, I guess it's a combination of multiple factors. The bid-ask, price difference, availability of financing, very difficult times raising equity capital. So all those factors together make it very difficult for the deals to take place. Although the theory is as transaction volume starts picking up, maybe more price recovery will happen. So this is the whole conversation: is when will the price recovery happen, to what degree, and the volume. Yeah, it's been it's been low for everyone because investors are sort of, and I don't know if have you talked to investors. I'm just curious, sort of your investor sentiment. They're still very cautious, especially people who have invested in the past few years. Their experience is massive recency bias. They're nervous about what's going to happen with the capital they've invested. Even some bad deals already come through, so there's losses. So that whole crowd is just one unhappy crowd. They're wonderful folks, but the experience is tough. And what do you do? Are you seeing new investors going into the marketplace, fresh capital? Otherwise, funding a deal becomes very tough unless you have institutional partner who'll give you large amount of capital, but then you got to prove to them this is a phenomenal deal. Institutional investors are even tougher than high net worth individuals. Just
Right.
curious, what are you seeing?
I mean, we're still doing calls with new investors and potential new investors, and building out our list for investors. But it's when I follow up and speak to investors by email during the week, and I mean, a lot of them that haven't invested with us, just that are on our, on our list that I follow up with, a lot of really negative experiences, like you were saying, and I mean, there's people that have been, just like a lot of people, I don't see coming back in that have invested with other operators and lost money, or they don't hear back from the people. Tons of horror stories from people that are in mentorship groups. There's probably 4 or 5 off the top of my head that I've heard in the last 2 weeks of people losing their money, being part of some sort of fraud within it. So it's difficult. I mean, when the deals, like when you're not able to add value and you're not able to, sell the property for twice what you bought it for 4 years ago. I mean, the whole thing starts melting down, and that's not really how this whole industry is supposed to be. It's supposed to be buying good properties for long periods of time, and when I say long periods of time, like at least 5 years, and that's typically how it used to run. And you're building wealth over that part. It's not supposed to be where I go into something, raise rents 50%, and then sell it in a year and a half. And I think that type of mentality is what was happening, which people got sucked up in, because you talk to people and they're like, multiple deals from operators done, operators not responding to them. I'm keeping my money in in bonds or treasuries and stuff, and all this stuff. So this is what you're hearing. And yeah, it's difficult to raise money. And then you also can tell, we both have podcasts. I imagine you get people reaching out to you. I've had large operators reach out to me, and with the ultimate goal of coming on the show and raising money for a deal. And so that's not something that normally happens. And it's something that I've just seen really this year come around, where they're having problem raising money too, especially if you have capital calls. You know what I mean? With a lot of investors don't know if their capital calls haven't made their way through. So there's still loan workouts. I mean, you still have deals from 2022 that aren't, you're in that part right now where your interest rate caps are coming up. So, you know what I mean? So it's they might not be there yet. You have loan workouts. They're doing all this stuff, and hasn't come out yet. So if you're a passive investor, you might not know the damage of your property until end of this year that you're in the clear, depending on how everything goes. And it's just a lot of deals I looked at. I remember one deal I saw we were going to partner on. We were looking at one deal, and we just reviewed it, and we turned it down. Ultimately, 2 years later, I saw it come up as being foreclosed. So a lot of deals and a lot of operators that you work with, you really have to double check them, and you have to do all your own due diligence on the operator, and then also on the deal itself and on the market, and verify a lot of those assumptions. Because when I look back at the deal, it's actually, I use that deal as a case study with some students that I teach. And if you go back through it and you just have it's a laundry list, every time you look at it, it just gets longer and longer of stuff that's wrong with it. And main thing was that they're buying a value add property, trying to value add it again. And that just doesn't work. You know what I mean? If that group had bought it, put 10-year debt on it, they'd be in a whole different situation now, right? And they're knowing that we're going to give you single-digit returns on this and hopefully sell it in the future for this. That's a different business plan. But it's difficult when you're trying to mend strategies together to try to get to these high returns that I really just don't see a way of them achieving.
Well, everything you said is back to the recency bias. It's past. It's almost to the point where there needs to be a reset, and there was a reset, and it's very difficult to convince existing investors. Not even convince. I mean, at this point, they will, whether they like it or not, just like you said, they're realizing it through hard experiences. There was a massive reset. Assumptions were, call them aggressive. Well, why? Because the market was aggressive. A lot of things were aggressive. Rent growth were aggressive. A lot of assumptions on value-add projects, bridge debt that we would be able to refi after the work was done in 2 years. Insurance higher, number of other challenges, obviously collections. So the market is essentially went through a significant reset. And the thought process today, I wish there's a way to press a button, complete reset, and get everybody's mindset. This is now sort of time to be greedy, not time to be fearful. It's the reverse. From that perspective, the fear is dominating and concerns are dominating from the last couple of years. And you're absolutely right. There's a wild west out there. I've heard these horror stories to the nth degree. Folks invested with complete shysters, Ponzi schemes, disappearing people, or maybe legit people, but troubled market conditions, right? So market conditions, higher for longer interest rates, very few people expected this to happen. And the debt service is basically pressuring a lot of deals from liquidity perspective. So maybe if you live until 26, you'll be fine, but you got to live until 26. Meanwhile, you need to pay the bank, either buy a fresh rate cap, like you said, the whole conversation started, or you need to put interest reserves where the money is going to come from. It's not a trivial conversation, and capital calls are tough. Most investors are in some of them are just not in a position to even fund it, right? So I'll leave that alone, and I want to kind of move forward for a little bit, just sort of your outlook for the next 6-12 months, and then how would folks reach out, just sort of turning to positivity, because I think it's actually a phenomenal time now to write fresh checks. You could find we have a deal we wrote a check this week, which is a deep buy for it's a mixed use. Over 300 apartments anchored by a super Walmart. On that deal, the cap rate basically increased from, call it, the fourth to the sixes, right? That kind of a change based on the market conditions. That's a deep buy. Its IRR is conservatively targeted in the 20s. Like when we see deals like this, then immediately you know this is likely a phenomenal deal, right? So I'm very cautiously optimistic about fresh money going out, but how do you get to people the message across that if you're a new investor, if you're a stock market investor, you have not done real estate, now may be a phenomenal opportunity to actually participate, diversify from the appreciated stocks into what's trading cheap now. Multifamily real estate and other commercial real estate, excluding office aside, is trading at a steep discount. So have you I'm just curious your thoughts, because I feel it's a great opportunity, and you may not see every deal look like this, but there are deals that are strong deals. Another point that I heard is you're not looking for perfection, right? If you're looking for perfection, you're never going to find it. But if you're ballpark, something used to trade, let's call it $20 million, and now it's trading 25% less than $15 million. Just again, throwing a number on the table. Whether you're getting it for 15 or 16 is less relevant today because the discount is already there. And as rates fall, cap rates will fall and your valuation will improve. And then if you do the right capital structure today with more conservative leverage, you'll be totally fine on a forward basis. It's kind of one of these things. It's the reverse now. It's almost you can't go wrong now if you buy right versus you couldn't go right if you bought 2 years ago. Like very, very few things that you bought 2 years ago are doing really well now, unless you get fixed rate debt, some kind of stabilized asset that is, got long-term commercial lease tenants and high credit quality tenants. That's a different experience. But if you bought a value add deal last couple of years of floating rate debt, 90, probably 5% of them are in some kind of trouble.
Yeah. Yeah, no, it's true. It's definitely true. I mean, if you're getting deals that have, like you said, a deep buy, a discount like that. But what I was saying earlier is I don't see those. I don't see people putting out deals like that. I don't see business plans. I just don't see it. I don't see how people are making these numbers work as they did before, unless at the end of the day they're saying that interest rates are going to drop so much, and that's how they're penciling out these pro formas. But I think for investors that got burnt in real estate one way or another over the last couple of years, or that are coming in for the first time, I think use these experiences and put together like your investment philosophy as an investor, and put together your rules and of how you're going to invest differently now than you did years before, and different type of deals you're going to do, different due diligence you're going to do on operators, different due diligence you're going to do on deals and markets, different debt that you might look at or require. Different parts of the deal you're coming in. As you're talking, Mike, you're coming in with a lot of like mezz debt, stuff like this. People have to understand the difference between that and where they may be in common equity. And that might be not not the type of equity class they want to be in. Maybe they want to be a little closer up front if something goes wrong. And these are the decisions that people have to make. And I think putting it together, and it's not just retail investors that get put in these situations. I mean, it's one of those things with banks. Banks are notorious for lending when it gets crazy and opening up the lending standards. And then after everything kind of comes to a stop, they stop lending where it should be opposite, right? But it never works like that. And we've seen that cycle after cycle after cycle, especially with what happened in '08 and stuff like that. And what we're seeing kind of now with certain lenders. So I think it's a time for investors, like you said, to reset their mindset and to, look into real estate, figure out how you want to get involved with it and kind of what your actual investment goals are. And then allocate capital accordingly. Don't put so much money into certain deals with certain operators. Don't invest with certain operators so many times per year. These are simple things that you can do without even knowing anything about the deal to really limit your downside. And I think when I speak to investors with other operators, these people, they went against all of it. 3 different deals with the same operator in 1 year, saying, all these things, all these red flags that they did. And when they look back on it and they're being honest with me, it's something that now I can edit my own underwriting, my own investment philosophy as a passive investor and also as an active investor. So I think that's what we can take away from what's just happened here over the last couple of years.
Charles, great lessons. I concur. Lessons learned, right? Sometimes you win, sometimes you learn. That's the book. So at least exactly what you said, update your investment standards, investment philosophy. It's a great advice because if you don't, you will make probably the same mistake again. But I do want to comment, just do one quick comment. So a lot of people learn from it's called mistakes or difficult experiences, and the pendulum swings all the way the other way. So instead of realizing now is the market condition to be a little bit more opportunistic, they turn ultra conservative and they don't want to make the same mistake again. But it's almost the wrong thing to do. Now, maybe psychologically it's easy. If you had $10 million invested and you lost 6 million of that, your remaining 4 million feels like, oh my God, I want to preserve that money, right? I already lost 6. So that preservation of capital mentality kicks in, and there's nothing wrong with that. But the interesting thing is that yes, you should still improve your underwriting. You should still look through better assumptions, or at least scrutinize assumptions to get more conservative. But look at this way. You touched on one more point, and we'll wrap up. Folks look at the interest rates, and they, in order for the returns to pencil, you have to assume better interest rates. And folks say, well, we don't know that. The interest rates are going to be at the high level. We just don't know what's going to happen. So something really interesting happens. They essentially turn to ultra conservative underwriting, too conservative underwriting. Then you can't transact, you can't act, you can't take advantage of the opportunity simply because you are now, the pendulum swung all the way to the other side. And unless you see perfection, it becomes an action. So I'm just kind of commenting on this because I do agree with the whole update your underwriting, update your diversification, update your thinking, what kind of investments you want to look at. Before, people didn't even understand what they were really, what was the right suitability for their goals. They were just writing checks left and right, looking at the bright and shiny objects. Today, it's more of a, oh, I need income. Why am I writing a check into growth? And what's the risk profile? That's common equity. Can I be in the mezz debt or preferred equity? The crazy thing, I've said this more than once, but today, if you're not comfortable with common equity, if you feel too nervous about this because you lost a bunch of money, mezz debt today generates equity-like returns without equity-like risk. Now, it's still risk, but it's a very different experience versus the deals that were a couple of years ago. We've actually even seen some troubled deals from the last few years where we provided some mezz debt and we got paid in full, but the equity got beaten up completely, right? So if you're in a better position on a capital stack, you have to really know the difference. And if you don't understand the difference, same deal, everything else is the same. If you're on a primary debt, you're safe. You're mezz debt, you're safe. Common equity, you're destroyed, right? And maybe there's a borderline between, okay, maybe common equity make 20% back. Can mezz debt be recovered? Can preferred equity be recovered? These are the fundamental questions that folks really need to understand and hopefully gravitate to a level of comfort on the future deals. So that's kind of my parting thoughts. Any good book to recommend, or how would folks reach out?
I think my favorite book that I always tell people about is the 80-20 principle, Pareto's principle. I think that's something that people can utilize in every facet of their life, and you'll be amazed at how it fits with your life and with just common everything that happens, and how that kind of works into that ratio. So it's very interesting. And if you're interested in learning more about what we're doing, my company is harborsidepartners.com, and if you go to harborsidepartners.com, we have a lot of information there. Podcast, Mike was just on it. We have a YouTube channel, past investing guide, some other information, learn more about what we're up to, and, get on a call with us if you're interested in investing. And when we do have deals, we don't do that many, but when we do them, we will let you know right away.
Thank you, Charles. Appreciate you coming on a podcast. Thank you for sharing and your wisdom and great lessons. So I greatly appreciate it.
Thanks, Mike.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.